Most people think turning 65 means it's time to retire. Medicare kicks in, Social Security is available, and after decades of work, you've earned the right to step away. But here's what almost nobody tells you: retiring at 65 can be one of the most expensive mistakes you will ever make, not because you retired too early, because you didn't understand how the timing of your retirement affects everything else. Your Medicare premiums, your Social Security taxes, your out-of-pocket healthcare costs, even whether you qualify for programs that could save you thousands of dollars a year. I've spent 30 years practicing elder law, and I have seen this same mistake destroy retirement plans over and over again. Let me tell you about a client I'll call Margaret. She came into my office in the spring of 2019. She was 64 years old, about 8 months away from her 65th birthday. Margaret had worked for 27 years as an office manager at a regional insurance company in Hendersonville. Good job, steady income, about $58,000 a year. She had been planning her retirement for the better part of a decade. She had her date circled on the calendar, July 15, 2019, the day she turned 65. She was going to retire, start collecting Social Security, sign up for Medicare, and finally travel to see her grandchildren in Oregon. Margaret was doing what everyone told her to do. She talked to HR, she talked to her financial advisor, she even attended a retirement seminar at the community college. Everything pointed to the same answer: retire at 65. So she gave her notice, she had her going-away party, she cleaned out her desk, and 3 weeks after she retired, she came to see me because something felt wrong. She had just received her first Medicare premium notice in the mail, and the number didn't make sense. Instead of the standard Part B premium of $135.50 per month that everyone kept talking about, her premium was going to be $270.90, exactly double. She thought it was a mistake. She called Medicare. They told her it was correct. They told her it was because of something called IRMA, Income-Related Monthly Adjustment Amount. Margaret had never heard that term in her life. Here's what happened. Margaret's income in the 2 years before she turned 65 was $58,000. Because she worked those full years, her modified adjusted gross income pushed her just over the threshold for higher Medicare premiums, not by much, just enough. And because Medicare looks back 2 years, her 2017 and 2018 income determined her 2019 and 2020 premiums. If Margaret had retired even 6 months earlier, if she had reduced her income in 2018, she would have avoided that surcharge entirely, but nobody told her that. Not her financial advisor, not HR, not the retirement seminar. Over the next 2 years, that decision cost Margaret an extra $3,256 in Medicare premiums alone. And that's just Part B. When we looked deeper, we found that her Social Security benefits were also being taxed at a higher rate because of how her income stacked in that transition year. By the time we added everything up, retiring on her 65th birthday instead of retiring strategically earlier cost Margaret close to $7,000 in the first 2 years of retirement. $7,000 she didn't have to lose. Margaret's story is not unique. It is the rule, not the exception. And the reason this keeps happening is because most people do not understand how retirement timing intersects with 3 major systems that all operate on different calendars and different look-back periods. Social Security looks at your lifetime earnings record and your filing age. Medicare looks at your income from 2 years ago. The IRS looks at your income from last year when calculating taxes on your Social Security benefits. And if you do not understand how these 3 systems talk to each other, you will lose money. A lot of it. Let me walk you through the 3 biggest mistakes people make when they retire at 65 without understanding the full picture. And I want you to pay very close attention to number 3, because that is the one that costs people the most money over the long term, and it is the one almost nobody sees coming. Mistake number 1 is triggering IRMA without realizing it. IRMA stands for Income-Related Monthly Adjustment Amount. It is a surcharge that Medicare adds to your Part B and Part D premiums if your income exceeds certain thresholds. And here is the part that catches everyone off guard. Medicare determines your RMAA surcharge based on your income from 2 years ago, not your current income 2 years ago. So if you retire in 2025, Medicare is looking at your 2023 tax return. If you were still working full-time in 2023 and earning a good salary, you are going to pay higher Medicare premiums in 2025, even though you are now retired and living on a fraction of that income. The thresholds change slightly every year, but as of 2024, if you are filing as a single person and your modified adjusted gross income was more than $103,000 2 years ago, you pay more. If you are married filing jointly and your combined income was more than $206,000, you pay more, and the surcharges are not small. At the lowest surcharge tier, you are paying an extra $76.40 per month for Part B. That is $916.80 per year. At the highest tier, you are paying an extra $407.90 per month. That is $4,894.80 per year, just for Part B alone. And Part D premiums get surcharged too. Now let me put this in plain English for you. If you retire at 65 and you were earning a solid income in the 2 years before that, you are going to get hit with EMRAA surcharges for the first 2 years of your retirement, even though your income has dropped. Medicare does not care that you retired. They are looking backward, and if you did not plan for this, it feels like you are being punished for having worked hard and earned a decent living, because in a way you are. I had a client named Thomas who retired at 65 after 32 years as a regional sales manager. His income in his final 2 working years was around $120,000, solid middle-class income. He and his wife Linda had saved carefully. They had a plan, but when Thomas enrolled in Medicare, his Part B premium was not $174.70 like he expected. It was $244.60, an extra $69.90 per month. Over 2 years, that was an extra $1,677.60 they had not budgeted for. Thomas came to me frustrated because he felt like he had done everything right. He worked hard, he saved, he filed his taxes on time, and now he was being charged more for the same Medicare coverage his neighbor was getting for less. And I had to tell him the truth. He was right. It is not fair, but it is the law. And the only way to avoid it is to understand it ahead of time and plan your retirement timing around it. Here is the strategy most people miss. If you know you are going to be close to an RMAA threshold, you want to reduce your income in the 2 years before you turn 65. Not the year you turn 65, 2 years before. That might mean retiring at 63 instead of 65. It might mean switching to part-time work. It might mean deferring a bonus or declining overtime in those critical look-back years. I am not saying everyone should do this, but if you are in that income range where RMAA is going to cost you $2,000 or $3,000 or $4,000 a year, it is worth running the numbers to see if an earlier retirement or a strategic income reduction could save you significantly more than you would lose by stepping back sooner. Now I want to be very clear here. This is not about cheating the system or hiding income. This is about understanding how the system works and making decisions that are in your best interest. You worked for that money. You paid into Medicare your entire working life. There is nothing wrong with structuring your retirement in a way that minimizes unnecessary costs. Mistake number 2 is not understanding how working in the year you turn 65 affects your Social Security taxation. A lot of people assume that once they start collecting Social Security, those benefits are tax-free. They are not. Depending on your total income, up to 85% of your Social Security benefits can be subject to federal income tax. And the calculation that determines how much gets taxed is based on something called combined income. Combined income is your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. If your combined income as a single person exceeds $34,000 or as a married couple exceeds $44,000, up to 85% of your Social Security benefits become taxable. Here is where retiring at 65 creates a problem. Let's say you work the first 6 months of the year and earn $30,000. Then you retire in July, start collecting Social Security, and receive $12,000 in benefits for the second half of the year. Your combined income for that year is $36,000 in wages plus $6,000, which is half your Social Security, for a total of $42,000. You just crossed the threshold. Now, a significant portion of your Social Security benefits are going to be taxed. If you had retired in December of the prior year and only collected Social Security in the year you turned 65, your combined income would have been much lower, and you might have avoided taxation on those benefits entirely, or at least reduced it significantly. I represented a couple named Robert and Susan who both retired at 65 in the same year. Robert had been a high school teacher. Susan worked in hospital administration. Together they earned about $98,000 in the first 8 months of that year before they both retired. Then they started collecting Social Security and brought in another $16,000 in benefits for the remaining 4 months. When they came to see me the following spring, they were shocked to learn that they owed federal income taxes on a large portion of their Social Security benefits. They had assumed Social Security was tax-free. It is not. And because they both worked deep into the year they started collecting, their combined income was high enough that 85% of their benefits were taxable. We are talking about an extra $3,400 in federal taxes that year that they did not anticipate. They could have avoided most of that tax hit if they had retired at the end of the prior year instead of mid-year. The third mistake, and this is the one that I think matters most over the long term, is losing eligibility for programs that help with healthcare costs. There are federal and state programs designed to help lower-income seniors afford Medicare premiums, deductibles, and prescription drugs. The big ones are the Medicare Savings Programs and Extra Help, also called the Low-Income Subsidy for Part D. These programs can save you thousands of dollars per year. But here is the catch. Eligibility is based on your current income and your assets. If you retire at 65 and you are still showing a full year of working income on your tax return, you might not qualify. But if you had retired 6 months earlier and reduced your income below the threshold, you could qualify. Let me give you a real example. I had a client named Dorothy who worked as a cafeteria supervisor at an elementary school. She earned $26,000 a year. She lived modestly. Her only other income was about $4,000 a year from a small pension. When she retired at 65, her total annual income dropped to just that $4,000 pension plus her Social Security benefit of around $14,000. That put her total income at $18,000 per year. In North Carolina, that income level qualifies her for a Medicare savings program that pays her Part B premium. That is $2,094.40 per year that she does not have to pay. But here is the problem. Dorothy did not know about the program until a year after she retired. And because she worked the full year she turned 65, her income that year was $30,000, which disqualified her for that entire year. She lost out on $2,094.40 in assistance simply because she did not retire earlier and reduce her income before crossing the eligibility line. Programs like this exist in every state, and millions of seniors qualify but never apply because they do not know the programs exist, or they apply too late, or they disqualify themselves by retiring in a way that keeps their income artificially high during the transition year. This is not about gaming the system. This is about understanding that the decisions you make about when to retire and how to structure your income in that transition period can determine whether you qualify for help or whether you are on your own. So what do? Let me give you 3 practical steps you can take right now if you are approaching 65 and thinking about retirement. Step 1. Pull your tax returns from the last 2 years and look at your modified adjusted gross income. That number is on line 11 of your Form 1040. Write it down. Then go to Medicare.gov and search for RMAA brackets for the current year. Compare your income to the thresholds. If you are close to a threshold or over it, you need to understand that your Medicare premiums are going to be higher than the standard rate, and you need to budget for that. If you are right on the edge of a bracket, talk to a tax professional or a financial planner about whether it makes sense to reduce your income in the look-back years by retiring earlier, going part-time, or deferring income. Step 2. If you are planning to start Social Security in the same year you retire, run the combined income calculation. Take your expected wages for the year, add half of your expected Social Security benefits, and see where you land. If you are going to cross $34,000 as a single person or $44,000 as a married couple, you need to know that a portion of your Social Security will be taxed. It might make sense to retire at the end of the prior year instead of mid-year to keep that year's income lower and reduce the tax hit on your benefits. I am not saying this is the right move for everyone, but you need to know the math before you pick a retirement date. Step 3. Research whether you qualify for Medicare savings programs or extra help. Go to your state's Medicaid website or call your local area agency on aging. These programs have income and asset limits, but they are higher than most people think. In many states, a single person earning up to $18,000 per year can qualify for some level of assistance. If you are close to that range, it is worth applying. And if you are planning to retire soon, consider whether retiring a few months earlier could lower your income enough to qualify. The savings can be enormous. Now, I want to be very honest with you here. Not everyone should retire before 65. If you love your job, if you need the income, if your health insurance through work is better than Medicare, then staying makes sense. I am not telling you to retire early just to save on premiums. What I am telling you is this: do not retire at 65 just because that is what everyone else does. Do not retire at 65 because Medicare starts at 65 and you assume that is the signal. Retirement timing is not one size fits all. The right age to retire depends on your income, your health, your savings, your Medicare premium exposure, your Social Security strategy, and whether you qualify for assistance programs that could save you thousands. I think about my father a lot when I talk about this. He worked 38 years at the Alcoa aluminum plant. He retired at 64, not because he planned it that way, but because the plant offered an early buyout and he took it. At the time, I thought he retired too soon. I thought he should have worked another year, but looking back now, that decision saved him money. His income dropped in the year before he turned 65, which meant his Medicare premiums stayed low. He avoided RMAA entirely. He qualified for programs that helped with his prescriptions. He did not plan it that way. He got lucky. But a lot of people are not that lucky, and they lose thousands of dollars because nobody told them how the system actually works. The government does not owe you a phone call. Social Security is not going to send you a letter that says, hey, if you retire 6 months earlier, you will save $3,000 in Medicare premiums. Medicare is not going to tell you that working 1 extra month might cost you eligibility for a program that pays your premiums. You have to figure this out yourself. Or you have to talk to someone who understands how all these systems connect. That is what I do. That is what I have been doing for 30 years. If this video helped you see something you did not see before, I would appreciate it if you left a comment and told me where you are in this process. Are you close to 65? Are you already retired and dealing with RMAA? Are you helping a parent figure this out? I read every comment, and sometimes your questions become the next video. And if you know someone who is planning to retire at 65 and has not thought about any of this, please share this with them. They need to see it before they make a decision they cannot undo. Knowledge is your best policy,